Sanctions are a powerful economic tool. They're designed to cripple a nation's economy without armed conflict. In the case of Russia, sanctions aim to punish its invasion of Ukraine. The goal was to weaken Russia's financial system and pressure its leaders into a change of behavior. These sanctions targeted key sectors. They included financial institutions, energy companies, and wealthy individuals. By cutting off access to international markets, the sanctions sought to isolate Russia economically. The hope was that this would reduce its ability to finance military operations. However, sanctions are a double-edged sword. While they can cause significant harm to the target country, they also have global repercussions. The interconnected nature of the global economy means that sanctions on Russia could lead to a financial crisis that affects many nations. Understanding the full impact requires looking at various aspects. From the strain on Russian oligarchs to the ripple effects on global markets, each factor plays a role. This essay will explore these dimensions and assess whether the world is prepared for such a crisis. Sanctions are a powerful economic tool. They aim to cripple a nation's economy without armed conflict. Sanctions on Russia punish its invasion of Ukraine. The goal is to weaken Russia's financial system and pressure its leaders, targeting key sectors like financial institutions and energy companies. Cutting off access to international markets isolates Russia economically, reducing its ability to finance military operations. Sanctions are a double-edged sword. They can harm the target country and have global repercussions. Russian oligarchs were among the first to feel the bite of sanctions. These wealthy individuals hold significant assets abroad. The sanctions aim to freeze these assets, limiting their financial power. Yachts, mansions, and bank accounts were seized or frozen. The impact on oligarchs was immediate and profound. Their ability to move money internationally was restricted. This not only affected their personal wealth, but also their business operations. Many oligarchs had investments in Western companies and properties. These were suddenly out of reach. The targeting of oligarchs also served a strategic purpose. By hitting those close to the Kremlin, the sanctions aimed to create internal pressure. The hope was that these powerful individuals would push for a change in government policy. This internal dissent is a critical component of economic sanctions. However, the strategy also had unintended consequences. The sudden freezing of assets led to a rush to move wealth to safer locations. This caused disruptions in international financial markets. Banks and financial institutions had to navigate the complexities of compliance, adding to the strain. Sanctions on Russian financial institutions were severe. Major banks were cut off from the SWIFT network. This made international transactions difficult. The aim was to isolate Russia from the global financial system. The immediate impact was significant. Russian banks faced liquidity issues. They struggled to meet international obligations. The sanctions also led to a loss of confidence in the Russian banking system. Depositors rushed to withdraw their savings, fearing bank failures. The central bank had to step in. It provided emergency liquidity to stabilize the system. However, this was only a temporary fix. The long-term outlook remained bleak. The sanctions limited Russia's ability to access foreign currency reserves, further straining the economy. The banking sector was not the only one affected. Major companies also faced difficulties. They struggled to access international credit and make payments. This disrupted supply chains and business operations. The overall effect was a slowdown in economic activity. The sanctions led to a sharp devaluation of the ruble. The currency lost significant value against the dollar and euro. This had immediate effects on the Russian economy. Imported goods became more expensive, leading to inflation. Consumers felt the pinch. Prices for everyday items rose rapidly. Inflation eroded purchasing power, making it harder for people to afford basic necessities. This created social unrest and increased pressure on the government. The devaluation also affected businesses. Companies that relied on imported materials and equipment faced higher costs. This impacted production and profitability. Many businesses had to raise prices, further fueling inflation. The central bank had to act. It raised interest rates to combat inflation. This made borrowing more expensive, slowing down economic growth. The combination of high inflation and slow growth created a challenging environment for policymakers. Section 5. The role of international correspondent banks. International correspondent banks play a crucial role in global finance. They facilitate cross-border transactions and provide liquidity. The sanctions on Russia put these institutions under significant pressure. Correspondent banks had to comply with the sanctions. This meant cutting ties with Russian banks and companies. The process of debanking was complex and fraught with challenges. Banks had to navigate the legal and regulatory landscape to ensure compliance. The impact was not limited to Russia. Correspondent banks had to reassess their risk exposure. This led to a tightening of credit and liquidity in the global financial system. Banks became more cautious, affecting international trade and investment. The role of correspondent banks is vital in the global economy. Their ability to facilitate transactions is essential for economic stability. The sanctions on Russia highlighted the vulnerabilities in this system. It became clear that disruptions in correspondent banking could have far-reaching effects. Section 6. Debanking and its implications. Debanking is the process of removing banking services from certain clients. In the context of the sanctions, this meant cutting off Russian banks and companies. The implications of debanking were significant. For Russian entities, the loss of banking services was a major blow. It made it difficult to conduct international transactions. This affected trade and investment. Companies struggled to pay for imports and receive payments for exports. The overall effect was a contraction in economic activity. The process of debanking also had wider implications. International banks had to reassess their client relationships. This led to a tightening of credit and liquidity. Banks became more cautious, affecting global financial stability. The concept of debanking raised important questions. It highlighted the power of financial institutions to influence economic outcomes. The actions of banks had far-reaching effects, both for the targeted country and the global economy. This underscored the need for careful consideration of such measures. Section 7. Russia's countermeasures and alternative financial systems. In response to the sanctions, Russia implemented several countermeasures. The country sought to develop alternative financial systems. These measures aimed to reduce dependence on Western financial institutions. One of the key strategies was the development of a national payment system. This system allowed domestic transactions to continue despite the sanctions. Russia also explored partnerships with non-Western countries. This included increasing trade with China and other emerging markets. Another countermeasure was the accumulation of gold reserves. Russia sought to build a financial buffer to withstand the economic pressures. The central bank increased its gold holdings, providing a hedge against currency devaluation. The development of alternative financial systems had mixed results. While it provided some relief, it was not enough to fully offset the impact of the sanctions. The Russian economy remained vulnerable. However, these measures highlighted the potential for countries to develop independent financial systems. Section 8. Broader global implications, energy price spikes. The sanctions on Russia had broader global implications. One of the most significant was the impact on energy prices. Russia is a major exporter of oil and gas. The sanctions disrupted these exports, leading to price spikes. Energy prices rose sharply. This had ripple effects throughout the global economy. Higher energy costs increased the cost of production for many industries. This led to higher prices for goods and services, contributing to global inflation. The impact was felt by consumers and businesses alike. Households faced higher utility bills and fuel costs. Businesses saw increased production costs, affecting profitability. The overall effect was a slowdown in economic growth. The energy price spikes also had geopolitical implications. Countries that relied on Russian energy had to seek alternative sources. This led to shifts in global energy markets and alliances. The disruptions highlighted the interconnected nature of the global economy. Section 9. economic interdependence and market collapses. The global economy is highly interconnected. The sanctions on Russia underscored this reality. The disruptions to trade, investment and financial flows had far-reaching effects. One of the potential consequences was the risk of market collapses. Financial markets are sensitive to uncertainty. The sanctions created a climate of uncertainty and risk aversion. Investors became cautious, leading to volatility in stock and bond markets. This had the potential to trigger market collapses. The economic interdependence of countries also played a role. The sanctions affected not only Russia, but also its trading partners. Countries that relied on Russian exports faced economic challenges. This created a domino effect with potential for a broader financial crisis. The risk of market collapses highlighted the importance of stability. Policymakers had to navigate a delicate balance. They needed to maintain pressure on Russia while avoiding a global financial meltdown. This required careful coordination and international cooperation. Section 10. Conclusion. Strategic policies and international cooperation. The sanctions on Russia highlighted the complexities of global economic policies. While the intent was to pressure Russia, the broader implications were significant. The risk of a global financial crisis was real and required careful consideration. Strategic economic policies were essential. Countries needed to assess the potential impacts of sanctions. This included understanding the vulnerabilities in the global financial system. Policymakers had to develop strategies to mitigate these risks. International cooperation was also crucial. The interconnected nature of the global economy meant that no country could act in isolation. Coordinated efforts were needed to manage the impacts of sanctions and maintain stability. This included working with international financial institutions and other countries. The sanctions on Russia served as a reminder of the delicate balance in global finance. The potential for a financial crisis underscored the need for careful planning and coordination. By understanding the risks and working together, countries could navigate this challenging landscape and ensure economic stability.